All right, let's get right into it. Today, we are digging into a seriously bold call from one of Wall Street's biggest bulls, Tom Lee, over at Fundstrat. Now, as a CFA, my job is to cut through all the noise for you, and trust me, the logic behind this call is something you're gonna wanna hear. So this is the big one, right? The question every single investor is asking themselves. After this incredible run-up, is the party finally over? Is this bull market completely out of gas?
Well, if you ask Tom Lee, the answer is a loud, clear no. In fact, he thinks the party is really just getting started.
So, just how big of a party are we talking about? His target for the S&P 500 by the end of the year is 6,900. And nope, that is not a typo. It's a huge, audacious call, so let's really break down his argument piece by piece. Okay, so here's the game plan. Lee's case basically stands on three main pillars. First, a surprisingly tough U.S. economy. Second, not one but two massive tech supercycles happening at the same time in AI and blockchain. And third, the really weird psychology behind this rally that almost nobody seems to believe in. We're going to tackle each one, and then we'll get to the most important part, what it all means for your bottom line. So everything starts with the U.S. economy. The absolute core of Tom Lee's argument is that the pessimistic, bearish case that so many people have been clinging to is just fundamentally broken. And here's where it gets a little counterintuitive. A really key indicator, the ISM Manufacturing Index, has been in a slump for 31 months straight. That's the longest in history. Now, normally, that's a five-alarm fire-screaming recession. But Lee sees the complete opposite. He argues that historically, a slump this long and this deep isn't a sign the economy is about to die. No, it's a mid-cycle signal that things are actually getting ready to re-accelerate. I mean, just stop and think about what this economy has weathered. In just the last 5 years, we've been slammed with 6 different events that could easily be called black swans. A global pandemic shutdown, total supply chain chaos, the fastest rate hikes in modern history. Any one of those should have been a knockout punch. And get this, after surviving all of that, the market is somehow cheaper now than it was before. The S&P 500's price-to-earnings ratio was at 18 before all those crises. Today, it's at 17. The market proved it could take a massive punch, and yet its valuation is actually lower. Lee's point is simple, that P/E ratio should be going up, not down. Okay, a resilient economy is the foundation, but the real rocket fuel for this rally, according to Lee, is the AI supercycle. And he's convinced this isn't just hype. This is a huge structural shift, and we are still in the very, very early innings. And we can actually put a number on this thing. The research firm IDC is forecasting that spending on AI-related IT is going to hit an absolutely staggering $1.3 trillion by 2029. That's a tidal wave of cash that's about to be spent. But I know what you're probably thinking. Isn't this just another bubble? Look at a stock like NVIDIA. It's a totally fair question, and one we need to put into some perspective. Okay, you're gonna love this. NVIDIA, the company that is literally selling the picks and shovels for this new gold rush, trades at about 26 times its forward earnings. Meanwhile, you've got Costco, a fantastic company, don't get me wrong, that sells membership cards and those legendary $1.50 hot dogs, trading at 49 times forward earnings. As Tom Lee likes to joke, NVIDIA would probably have a higher multiple if it sold rotisserie chickens. The point is, the key player in AI actually looks pretty reasonable next to a premium retailer. So, what's really driving all this investment? It's not just hype, it's a necessity. You see, for the first time since 1973, the world's workforce of prime age people is growing slower than the total population. We literally have a structural shortage of humans to do the work, which is forcing companies, basically, to invest in non-human labor. And that means AI and automation. But AI is only half of the tech story. There's a second revolution happening right now, and it's a little more under the radar. It's happening on Wall Street itself. This massive bet on blockchain to make everything synthetic. So to get this, let's just take a quick trip back to 1971. That's when the US dollar was taken off the gold standard. It basically became a synthetic currency, no longer backed by a physical thing. To make that new world work, Wall Street had to invent a whole universe of new financial products. Tom Lee argues we are on the verge of that exact same kind of shift. But this time, it's not just the dollar, it's every asset. Stocks, bonds, real estate, all of it being tokenized and put on a blockchain. The potential size of this is it's mind-boggling. Treasury Secretary Besson estimates that the market for just stablecoins could explode from around $250 billion today to $3.7 trillion. This isn't just moving money around. It represents a massive productivity boom as finance moves onto a much more efficient digital backbone. Okay, so we've got a resilient economy plus two powerful tech supercycles pushing things forward. So why on earth is everyone so bearish? This brings us to the last and maybe the weirdest piece of the puzzle, the psychology of this truly hated rally. And the data here is just undeniable. The AAII survey, which tracks individual investors, showed more bears than bulls for 5 straight weeks, even while the market was hitting all-time highs. A 34% rally should be met with champagne corks popping. Instead, it's being met with deep, deep skepticism. It's one of the most distrusted rallies on record. So, what gives? Why the disconnect? Well, Tom Lee has a pretty controversial theory, and I want to be clear, I'm just presenting his analysis here completely neutrally. He points to data showing this sort of political split in the financial world. The equity market, think hedge funds, VC, leans heavily Democratic, he says. The bond market, banks, mortgages, leans Republican. His theory is that the stock market's constant bearishness is partly driven by a political distaste for the current administration, while the bond market, which is more focused on the hard economic data, stayed calm and correctly read the economy's underlying strength. It's a pretty provocative take, for sure.
So let's bring this all home. What does this really mean for your portfolio? Because at the end of the day, that is all that matters. What is the actual, tangible cost of all this skepticism?
This quote from Tom Lee just nails it. Since 1928, the S&P 500 has averaged about an 8% annual return. But if you miss just the 10 best days, your return collapses to -3%. The overwhelming majority of the market's gains come in these short, explosive bursts. And this chart just drives that point home in the modern era. Since 2015, if you just stayed in the market, your annual return was around 12%. Nice. But if you got spooked, went to cash, and missed just the 10 best days, your return becomes a jaw-dropping -10%. That is the brutal, wealth-destroying cost of trying to time a market that you don't trust.
So let's wrap this up. This market has survived 6 black swan events in just 5 years, proving the skeptics wrong at every single turn. Tom Lee's case is that the fundamental drivers, from the economy to technology, are still incredibly strong. And that really just leaves us with one final question to think about. What's your strategy going to be before the 7th swan inevitably arrives?